Is it finally time to buy Alibaba shares? The stock is down just shy of 1% today, and honestly, it's relatively flat after they've just reported earnings, and that gives us the opportunity to see whether or not Alibaba is something we want to add to our portfolios or not. This is the 3-year trend of Alibaba. They consolidated for a period of time, pushed up to highs of $300 per share, and has since declined all the way down to about $118. So, with that being said, that means there's been a massive decline in the stock. Is it warranted? Will the stock head lower from here? Or will we see a rebound, and is this a great time to pick up shares? That's what we'll find out in today's video. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to take a look at Alibaba's 2021 earnings, where we're going to check out their technical setups right now. We're going to also take a look at their financials, and then we'll finally conclude with a valuation of Alibaba's stock. And this is where we'll be able to determine whether or not Alibaba is something we need to add to our portfolios immediately, or if we're better off waiting or even trading. And if you enjoyed the analysis and investing perspective, please like and consider subscribing for more of this content. So just before we jump into the earnings and the financials, let's actually just take a macro view of what has transpired with Alibaba over the years. So as we can see, an IPO back in around 2014 sometime, and we've had a nice run up ever since. The thing is with Alibaba, we are now on a massive downtrend. But what I want to make sure everybody is aware of is that this is something that has happened quite a few times with Alibaba. If we take a look back here in their 2018 highs, the stock had fell about 37%, only to then rebound 76% up to these highs, at which point it then once again declined another 30% or so. And then we had once again a subsequent climb in price higher, let's say about 75-80%. So is this common with Alibaba? Absolutely. This is something we've seen over the years. So the question now is, where do we head from here with Alibaba? Are we going to once again proceed higher with another push back up into the 200 price range and maybe even higher up into 300s again? Or have the technicals and the trend completely broke, and are we going to head lower from here? That is the question. That's what we're going to try to find out when we look at the financials, but nobody actually knows the true answer. Our job as retail investors is to just come in there, find businesses at a margin of safety, add them to our portfolios. 5 out of the 10 will work, and that's enough to exponentially increase our portfolio gains. So with that being said, let's take a look at the earnings highlights. All right, so let's take a quick look at our earnings highlights here for Alibaba. And the first thing that you're going to notice here is that revenue missed analyst expectations by about 3.2 billion RMB. However, that being said, this figure is actually about a 10% increase year over year in terms of revenue. On the earnings per share side of things, this actually beat by about 0.82 RMB. Not too much to write home about. It's what analysts had expected. Now, in terms of the highlights here, we can see that annual active consumers grew to 1.2 billion users globally. That's basically 1 in 7 people that you meet are using Alibaba. And for those of you who are big on the ecosystem and whatnot, they're also focused on carbon neutrality by 2030. So congrats to them for that. And then finally, when we get to their outlook here, really, they didn't talk too much about it, just that they're going to continue their investments. They're going to continue trying to grow the user base, and that's their focus right now. So let's take a quick look at the financials so that we can put a valuation on Alibaba. All right, so right now we're looking at the income statement here for Alibaba, and because they're based out of China, their financials are just going to look slightly different. They are going to report in RMB, which we'll see here. And along with that, as always, we're going to take a look at the bigger picture here. So we're going to look at the 9 months versus the 3 months here. So right away, we have revenues of 649 billion, increasing from 529 billion a year ago. That's nice to see. Cost of revenue has also increased pretty much across the board. And we get down here to this figure here of 25 billion. This is their impairment of goodwill. This is what they have stated earlier in this document has been a big drawdown on this report. And we'll see that in just a second. So we get to here, our income from operations. This is down significantly from 97 billion a year ago now to 52 billion. Again, this is because their costs are increasing more than their revenues. And then when we include in this impairments of goodwill figure, yeah, it looks pretty bad. So anyways, we deduct some more expenses and we get to net income here of 65 billion. Again, versus this 150 billion number 1 year ago. I mean, we're seeing some capitulation here, and this is not what you want to see from a business you're looking to invest in, or if you are already a shareholder of Alibaba, despite them having the massive active user numbers that they do of 1.3 billion people. So overall, their income statement is a big X for me. All right, so moving on to their balance sheet here, we can see this cash figure of 293 billion versus 320 billion basically a year ago. So we know that they've done some things with their cash. So it looks like they put that 30 billion just right back into their investments, as this has increased about 30 billion as well. Add up all their other current assets and we get to about 675 billion RMB versus the 643. I'm not too interested in their long-term assets. What I'm more interested in is obviously their debt serviceability. So current bank borrowings of about 8 billion plus non-current borrowings of about 37 billion, as well as 94 billion in unsecured senior notes. And we're looking at, let's say, about 140 billion RMB in terms of debt. We compare this to their current assets. They have 675 billion RMB. That's a check. We know that the debt is not an issue for Alibaba. They have tons of cash sitting there on the sidelines that they can do whatever they want with, including servicing the debt and their investments that they're heavily focused on. So their balance sheet is exactly what you'd want to see. It ticks all the boxes and it's a check for me. So moving on to, let's call it the free cash flow statement here. They made it really simple. They've already given you the net cash provided by operating activities here of 150 billion RMB. 1 year ago, it was 207 billion. So that's something to note. The next thing you want to see is CapEx, which is already listed for you. Subtract, let's say, 33 billion there. And we get to about 114 billion RMB in free cash flow. Or in other words, in US dollars, this is about $18 billion of free cash flow. All right, so let's jump into our calculator here to see if we can purchase Alibaba at a margin of safety despite the poor income statement that we saw. Remember, Alibaba can always improve on their income statement because, as they've stated, they're having some issues with their impairments to goodwill as well as their high investments in growth. And this is comparable to what we've seen with Amazon, where they're not paying a dividend and they're really just focused on growth. So if Alibaba can get back to those high growth numbers, we're going to see an insane appreciation in price. That being said, let's get into their numbers. So we have 17 billion in free cash flow in US dollars. Let's say by the end of the year, they can get to about $20 billion in free cash flows with a 10% return. They do not pay dividends. We know that they're growing at about 10% per year. And for the next 5 years, let's say they can grow at 8%. On a 20 PE, they should be valued at about $370 billion. In the best case scenario, this is where they get back to those high growth numbers. Let's say they grow again at 25% per year for the first 5 years. The next 5 years after that, let's say it's dropped down to 15%. They would be valued at $1.1 trillion on a 25 PE. In the worst case, let's say they start to slow their growth from here, 8% in the next few years, and the subsequent years we're only growing at about 5% on a 15 PE. They're valued at 227 billion. Now, this is very worst case, and it's not likely considering this is a business with 1.3 billion users worldwide. Now, how does this fit into our valuation? Well, if we take a look back here at our market cap, we're sitting at $309 billion. In our worst case scenario, yeah, we could pick up shares of Alibaba for a little cheaper, but if they can get back to those numbers, we can see massive appreciation in price. We're talking about 3x in stock price. And in what we can expect from Alibaba, which is to remain the same and not even achieve those high growth numbers that we know that they can, it's still undervalued by quite a bit. So in my eyes, Alibaba is undervalued. You need to do a little more research on this to see whether or not it's for you. But at these current valuations, Alibaba is very intriguing, and I'm considering a position in Alibaba. So with that being said, that's my analysis for Alibaba's most recent results. If you made it to this far in this video, thank you for watching, and until next time.